The bear has arrived for the stock market, what that means, and what might be next in this week's Fastest 4 Minutes in Finance. Hello again, I'm Scott Inman. Well, the S&P 500 index officially entered a bear market this week. What's that mean? A bear market is defined as a 20% or greater decline from the peak. The peak for the S&P 500 index was on January 3rd. Anyone who's looked at their 401k statement since then knows 2022 has already been rough. But until this week, it was not officially a bear market. So now that we have entered one, why does that matter? Well, first, let's look at what drove us there. And it's really the same reasons that have made 2022 a rough year. Inflation is at the top of that list. Most economists and investors believed that inflation had peaked in April, and when we got May numbers, we would see things start to trend down. They did not. Inflation ticked up to 8.6% year over year when numbers were released last Friday, and markets responded by plummeting around 5%. A sell-off continued this week and got us into bear market territory. But as we are fond of saying here, things are rarely as good or as bad as they seem. Is inflation bad? Yes. But when you look behind the overall numbers, things look a little different. The overall inflation measurement includes food and gas. Now, obviously, gas prices are driving a huge portion of the inflation data, and that is a drag on the economy. Gasoline was up 4% just from April to May. Food prices are up 5 to 6 straight months of 1% or more, depending on which item you measure. But gas prices and food prices are always volatile, meaning they go up and they historically come back down at some point. So excluding food and gas, that's called core inflation or core CPI, inflation did tick down slightly when compared to April. Now, that's always hard to feel good about because consumers spend the most on food and gas, and there's no question that long-term hot inflation will cause consumers to spend less. We need inflation to cool off to see the stock market improve. So how long might that take? Well, if we look at historical data as our guide, it could take very little time to hit the bottom of the bear market, or it could take a long time. Little help, right? Looking at a chart from LPL Financial, measuring the number of days it takes from the date the bear market begins to the date it ends can be anywhere from 1 day to 576 days. The average is 154. Each bear market has its own set of unique causes. LPL Research believes this one should be on the shorter side, historically speaking. But even if it's not, now is not the time to jump ship from your investments. Bottom line here, as hard as it is to see your account values go down that you're counting on for retirement, remember, you haven't sold anything, so you have not realized a loss. It's only a number on paper. If you have cash on the sidelines, now may be a good buying opportunity in the stock market. And as always, your financial plan should prepare for times like these. If it has, stick to your plan. Thanks for listening.